Hello, everyone. I am going to reset the audio on this. There we go. Uh, we are getting into chapter 8. And for some reason, I was thinking we had 11 or 12 chapters, but if I'm looking at it correctly, we only have 10, I think is what I'm seeing. Of course, the book isn't very big. And what it's trying to cover is a summary of a bunch of different things you would have learned in other classes, or you would have gotten like snippets, and then we put it all together in what's called strategic management, which is strategy. It's how do you win the game in business. So here's where we get into a fun one, because chapter 8 gets into, my apologies, chapter 8 gets into, well, I'll just read it to you. Chapter 8, corporate strategy, diversification, and the multi-business company. Now, I hope all of you are kind of freaking out like, wait, Bruce said we're not supposed to diversify, and that's a bad thing. Well, we're going to get into it. Okay. So, when we talk about diversification in business, the reason I freak out about it is because I've listened to students talk about business, and I think diversification is a buzzword, and it's a word young people have heard. Uh, if you were to go into, let me use this as an example. If you were to go into Harvard Business School's MBA program or their executive MBA program, and you have managers in there from all different types of industry and everything else, and somebody were to say the word diversify, everybody in the room would want to say, hold on, stop for a second. What are you talking about? Because diversification, or what we think of as diversification, is almost kind of anti-business, because business is about getting good at something, becoming very efficient at it, and then scaling it and doing it over and over again. The root of business, folks, or modern capitalism, is from Adam Smith and The Wealth of Nations. Okay. That's from the 1700s. I want to say it's the 1700s. It was a book that was written and used. There's videos all over online, very, very good ones talking about Adam Smith and how a lot of his theories were actually developed in order to show how capitalism could actually help eliminate poverty or reduce it, and how it was kind of a brilliant thing where if we have one group of people over here that, let's say, produces corn or grows corn, and you have hundreds of thousands of bushels of corn. Well, this village or this group of people, they're not going to be able to eat all this corn before it goes rotten at some point. Then you have another group of people over here that they have a bunch of animals. They have a bunch of cows and ducks and other animals, and there's no way they're going to be able to eat all of the ducks and the cows okay, no, that sounds stupid. But you're going to have all of this excess. So they both do something really well. One grows corn, one raises livestock, but neither can consume as much as they have. In the process, they became very specialized. And that specialization is it is brilliant, because otherwise what we try to do is we try to become uh, jacks of all trade and masters of none. But when you have one group specialize in this and another group specialize in this, and we put that together, well, now we're both stronger. Okay. So that fundamentally is what capitalism is. It's the idea of specialization of labor and getting really good at something. And then you don't keep that and you hoard that. You give it to somebody else, but they have to provide you of something with value. And then you have this bartering process that goes on and on and on until somebody says, well, wait a minute, we don't know if we need more cows. We actually have quite a few cows or got enough. Uh, but we have all this corn and well, let's go to another village. And then at some point somebody says, it'd be a lot easier to exchange all this through like some other system. So somebody comes up with money and then you create this economic system. And the the evidence in the last 200 years of how capitalism has been democracy and capitalism has been the dominant system that has worked. And I say that in opposition to like communism and socialism. Communism being very, very far left in the ideology of it. And on the far right, you have like more of a capitalism idea. So communism and structuring your government like that, you have to understand it. There is some sense in communism. Okay. And the problem that exists, and the best, fastest way I can explain it is we produce enough food on our planet for everyone to eat 1.2 times what we probably could eat. Okay. So we produce about 20% more than ever gets consumed. And yet we have people on planet Earth that are starving. And there's a question to say, well, why is that? Why, even in the United States, why do we have people that are starving when we have produced enough food to feed everybody 1.2 times over again? And the answer is because there's a control mechanism to this, and we don't know how to try to get that to other people. Um, yeah, you have challenges there, and imagine in Somalia in the 1990s when you have these warlords, you had all these countries and trying to come in and uh, bring in via airlines rice and hundreds of thousands of pounds of rice to feed all of these people in this famine, and you had warlords take it over and say no, they don't get it unless they give us something, and it yeah. So anyway, well, how do you fix that? How do you prevent that from happening? And the answer in this case was we're going to take it over. And that was kind of the point is we're going to take over Somalia. And then these warlords aren't going to be able to, take a hold of this. We're going to pass it out to each person. And it obviously it didn't end very well. But the point being that capitalism seems to be a more effective and efficient way. Is it fair? No. Is communism fair? Not unless you want to give your government all the power and the control on planet Earth. And then everyone has to buy into doing this system. And if you have people that are against it, well, then the system doesn't work. So then you have a government that comes in and tries to dominate, and it doesn't work well. Okay, so the idea behind capitalism, though, is this I is has fundamental components to it. One of them being specialization of labor. We get good at something, we produce it, we produce a lot of it, more than we'll ever need, and then we share it or we sell it to others who could use it, but because we're not going to do anything with it. And then they're going to give us money. And then if we need something, then we're going to go buy something. We're going to take that surplus money we had and we're going to go buy something else. Maybe we need bricks or whatever. Okay, so my point being with diversification, it goes against that capitalistic system. Okay, and that's why when we talk about diversification, I get like a little cringy because there is a type of diversification that can be very effective. And then there's a diversification, which is using the Ansoff matrix, kind of gives us the full story, where you don't know what you're doing and you're not going to get good at it. And then that means you just blew a lot of money in resources, raw materials, labor to try to do something or make something happen, and it all you did was spend more money than you would have otherwise if you would have just stuck with doing what it is you're good at. Okay. So knowing that fundamentally, we can kind of get into this next chapter, which is corporate strategy, diversification, and multi-business companies. Because we do have companies out there like a 3M that seems to have their tentacles in a number of different seemingly unrelated product lines and business lines. When you have one company that makes both the band-aids for surgery and simultaneously is also making sandpaper for industrial, construction. Those are very unrelated things. So how is that not diversified? And the answer is it is diversified a little bit, partially, but not fully. Okay. And when I say fully diversified, we're talking about from the Ansoff matrix, where you are producing a completely unrelated product to anything you've ever done. You don't know your first thing about producing this, and you're selling it to a new customer that you've never sold to and you know nothing about. That is total or fully diversified. Okay. So let's just get into this. I may end up having to stop here and we might have to turn this into two videos, but we'll see. So, our learning objectives understand when and how business diversification can enhance shareholder value. Now we get back into all of the stuff we talked about in chapter 2 in that master strategy tools. And I hope what you're going to see is what the book says and what Bruce says are actually pretty much the same thing. Okay. So you don't diversify unless you can create or enhance shareholder value. If that doesn't happen, then you shouldn't have done it. Okay. Explain how related diversification strategies can produce cross-business strategic fit capable of delivering a competitive advantage. Oh, now we see that it has to pair up with a sustainable competitive advantage. These aren't unrelated things. 3, recognize the merits of risks of corporate strategies keyed to unrelated diversification. Um, Now, when we say unrelated, I don't want you to confuse that with totally diversified because you'll learn that unrelated might look unrelated, but the core competency still might be what it is that company does best. Okay. So again, it's not, they're calling it unrelated. Um, Even when you get into what seemingly looks unrelated, it's probably not unrelated. Okay. Evaluate a company's diversification strategy. Why would we want to do such a thing? And there is a time when you do want to do that. And 5, identify a diversified company's 4 main corporate strategy options for solidifying its diversification strategy and improving company performance. Just as a side note, I don't know if the authors of this book will ever watch any of these videos I produce, but I find it kind of interesting when I look at this. Uh, when you compare, oh, what is it? John Gamble, Margaret Peter Teff, and Arthur Thompson. And one of the things when I read management experts, I wonder if they really understand finance. Because if you understand both of these things, you come to the same place I got to. Okay. There is no unrelated diversification because it provides no shareholder value. And even though business risk and business strategy is what we're trying to go after, not financial strategy, business strategy, that doesn't mean you can ignore the shareholder value thing. You don't have that option. Why? Because if you ignore what the principal wants, the shareholder, the owner, the investor, guess what happens to you as the agent? You get fired. Okay, you're gone. So by the nature of that, we've created a system whereby shareholder value has to be a part of this. I think where things get screwed up is you don't have, we screw up shareholder value, future shareholder value with today's shareholder value. Okay. And that's where, well, that can get pretty convoluted. Okay. When business diversification becomes a consideration, diversification is called for, and this is very, very, very important. Please remember this because you're going to see it on an exam. Diversification is called for when, one, there's diminishing growth prospects in the present business. Okay, so let's let's hit pause for a second because we're going to have to get out our master strategy and tools document. Okay. So when we look at our Ansoff matrix, we see that, okay, so the company has to grow. It has to do that for many different reasons. One of which is even if you have like a Nick's hamburger shop, even a Nick's hamburger has to grow to some level because its costs and its labor costs go up by a certain percentage. It's we most businesses plan that their cost COLA or their average wage that they are going to have to pay more next year than this year is about set to inflation. We figure somewhere between 2 and 3%. Okay. Because of that, either Nick's Hamburgers has to constantly raise its prices, which is an option, or it needs to grow and become more efficient and effective at what it does. Okay. But it has to do something. In some capacity, the financials, the revenue has to go up because the costs go up. So the question is, well, how do we do that? And our first option is market penetration. What's that? We try to push more of our existing products to our existing markets. Maybe we offer a sale. Another option is to develop a new market, which is we have our existing products, but we're going to sell them to a new set of people. Then over here, you have your product development, which is we're going to sell to the same people, but we're going to invent and innovate new products to sell to them, maybe 2.0 versions. And the last one is diversified strategy, which is fundamentally selling a new product, a product you know nothing about, to a customer you know nothing about. Okay. But the reality is, you do get into there's wiggle room in there and there's gray area. And the reason again I freak out about this so bad is because I think if students understood when 3M or General Electric or Caterpillar goes in to a business, what looks like a diversified business line, usually it's not fully diversified. It might be partially diversified, but it's not fully diversified. There is something there because otherwise Caterpillar's stockholders would not accept that their agents, the CEOs, the executives, are buying up these other companies, and there's no reason, there's no rationalization, there's no logic. So there's times where you have limited diversification, partial diversification in one direction, or partial diversification in another. What we almost never, ever, ever will see, unless the world has ended and you have no other choice, is a complete diversification that is totally 100% unrelated to anything the company is doing. That just does not happen because, again, the agents, the CEOs, the executives, don't, they can't go and argue this to their shareholders and say, well, we're Caterpillar, we make, machinery and equipment and construction implements and things like that. But we think Pizza Hut would be a good idea because all our people eat, our customers eat too. Well, why don't we go do that? Because Caterpillar knows nothing about the restaurant business. They know nothing about the pizza business. They know nothing about anything to do with Pizza Hut. So if Caterpillar tried to acquire a completely diversified business like Pizza Hut, it would not end well for the executives. They would get ousted. Okay. All right. So the reason again that I get so passionate about this is because I've ran into too many students that use this as a buzzword and they don't know what they're talking about. And that's not good. Okay. So diversification again is called for when there's diminishing growth. There's a time when you don't have a choice because they're no longer making trolley cars. So you got to start being in the transportation business. And that means, well, what are other forms of transportation? Okay. Two, an expansion opportunity exists in an industry whose technologies and products complement the present business. Complement. Okay. That means it can't be totally unrelated. It's got to be kind of related in some capacity. Three, existing competencies and capabilities can be leveraged by expanding into an industry requires similar resource strengths. Now, again, what are we saying there? What we're saying here is there's there's common denominators between these two businesses, even though they maybe don't look related. Let's use the trolley car manufacturer again. Uh, just wanting to make trolley cars. Well, guess what? Nobody's buying trolley cars in their cities. So now what are you going to do? And the option might be, well, get into the transportation business. Well, is there common denominators in making trolley cars in automobiles? Yes, there is. There's engineering and manufacturing components. There's the use of metal gears and all sorts of other mechanical engineering tools and techniques. And there's common denominators there. The engineers that can work on trolley cars can probably understand how the engineering works for automobiles. Okay, so even though they don't look related, there could be a relation in some way, somewhere in the supply chain. Four, costs can be reduced by diversifying into, again, a closely related business. Nowhere, anywhere in here are you going to say a fully, totally, completely, utterly unrelated business. Okay. So you can reduce your costs by getting into this business because it's closely related. And lastly, a powerful brand name can be transferred to the products of other businesses. Now, let's think about this one for a second. Would you ever see Pizza Hut getting into the stain removal business? Because I've noticed that when I go to the store a lot of times now, I see detergents who 50 years ago, you got Tide and you got, I don't know, what was some other brand, Gain, and there were five other options. You didn't ever see them working together. They were their own standalone companies, but over time they got bought out. Um, and what you see now is a synergistic pairing of putting one type of stain remover like OxyClean or Gain that has I don't know what Gain is. I guess it's a laundry additive of some sort. Maybe it smells good. You'll see Gain put into other cleaning products or other detergents to add whatever benefit Gain adds to doing this. You don't see Pizza Hut getting and pairing up with Tide to manufacture pizza smelling laundry detergent. Okay. Both of those companies have very powerful brands. Tide and Pizza Hut, or Pizza Hut's dwindling, but the reality is their stuff is just too salty. I mean, if we can be forthright, but that's neither here nor there. But you don't have Pizza Hut getting into the Gain laundry detergent business and having a little sticker put on the bottle saying, we have the meat lovers laundry detergent smell, whatever. That not related, doesn't have anything to do with each other. So when you do see brands that uh, transfer their brand value onto other things, they're not unrelated, okay, or not totally unrelated. I thought that was clever with the Pizza Hut and the Gain. So just so you know. Okay, now we have two slides here that I want to hit on, but the second slide here talks about a three test uh, question you have to answer before you start pursuing this diversified strategy. And you have to answer a certain way in these three questions. Before we get to the three questions, though, I want you to see what was down here on that slide, and I want to read it fully because, again, I don't want you getting screwed up with this idea of diversification. Okay. So before you get to the three test questions, diversification, and this is a quoting from the authors, diversification must do more for a company than simply spread its business risk across various industries. In principle, diversification cannot be considered wise or justifiable unless it results in added long-term economic value for shareholders. Okay. Goes back to what I said earlier. Because if you just try to buy another business or try to go into another business line and it's unrelated, it's extraordinarily costly to learn how to do that business. And at that point, your learning curve, your passive knowledge or tacit knowledge that needs to be learned is almost impossible and it's too costly. So you're destroying value, okay, shareholder value, because you're burning through cash. You're not getting as much revenue as you need to maybe do this. Well, then you're losing value. And if that's the case, saying losing value, it's a formula you need to have cemented in your mind, and it's the relationship between the discount rate, that capital asset pricing model rate. When that rate shrinks, the impact it has is the stock price goes up. And a lot of people don't understand that. It's they think that, well, you want that rate or that discounting cash rate, that or that risk-free rate, that risk adjusted discount rate, you want that high, don't you? No, it has nothing to do with any of it. What it has to do with is the stock value. So when that rate of return shrinks, that's like a good thing, especially if you're running that company, because it means you're reducing the level of risk. When you do that, that bucks up the stock value or the value of the stock price. Okay. So in essence, what we're saying here is the stock price needs to go up if you're taking on this business line. Okay. So it's not just the underlying business that matters. It's also what do the investors think of your business idea? Okay. So it has to add long-term economic value for shareholders. If it doesn't, again, you're going to be pushed aside and fired, or somebody's going to come after you and get rid of you because you have not used business logic to make decisions. A completely diversified strategy does not work because you'll be fired before it could materialize. Now, there might be a time where you still have to do that because you just have no other good options. But anyway, so the value that shareholders cannot capture on their own by purchasing stock in companies in different industries or investing in mutual funds to spread their investment across several industries. A move to diversify into a new business stands little chance of building shareholder value without passing these three tests. So literally your authors, which this should have been a big disclaimer, like a big warning thing going off, trying to communicate to you that diversification only works when it creates shareholder value. Okay. Why? Because your investors can go diversify their own holdings. They're going to go find the people that do know how to do that. And if they want to take part in that, they'll grab their own money and they'll go invest in that company. As the agent, that is not your job. Your job is to not diversify. It's kind of to do the opposite. It's to maximize what you're good at. Okay. So if you are to try to do this diversification thing, and it's partial, it's never fully and totally unrelated, you need to pass these three tests. Okay. It adds shareholder value when the target industry offers equal or better profit and return on potential investment opportunities. Okay. What does that mean? It means usually what it means is you see a company that's going into an industry or a field that's into a business that's unexplored. We don't fully know how this is going to unfold or materialize. But if it does materialize positively, then you might really have something here because maybe every household in the United States will want one of these things. Think about like an iPhone or a smartphone. Okay. So if you're IBM or you're Apple and you see this cell phone thing and you find almost everybody's buying a cell phone, well, what's the next? Where does this go next? And then all of a sudden you come up with a smartphone and now everybody needs one of these, that's over the age of 11. So there's an attractiveness to that because there's a realization that if you can be successful at this, oh wow, the boatloads of money you could make on this. But remember, hindsight's 2020. You don't know if it's going to work. Nobody knows if it's going to work. It could go in a totally different direction. The next test question, if you get into this diversified strategy, is the cost of entry test. The cost to enter the target industry cannot erode its long-term profit potential. What does that mean? If we use Apple again as they're trying to go after this new idea of a smartphone and they're going to use touch screen technology. They don't want to go into this if it's going to cost them $5 trillion to get the touchscreen technology to work. At some point, it's too much, and then you can't make that money back. So it's if you think about, I don't know, building a space station for 5 million people to live that orbits the Earth to get off the Earth or something like that, could that be done? Well, if the Earth is collapsing and I don't know, like the movie 2012 or something, if the Earth is collapsing, that might be wanted, it might be needed. But if the cost of it is so great, let's say 5 billion people have to die just to build the one space station for the 5 million people. 5 billion to 5 million is probably not a real worthwhile. That doesn't make sense. So the same is true when we're looking at a diversified strategy. Is the cost of entry acceptable enough in order to create that shareholder value? Number three, the better off test. The firm's business will perform better together than as a standalone firm, producing a synergistic 1 + 1 = 3 effect on the shareholder value. What does that mean? That gets us back into our Ansoff matrix. It gets us back into the business strategy and financial strategy in aligning these things. Okay. Nope. Actually, it gets into the mergers and acquisitions. Come on, towards the end here. Okay. So in mergers and acquisitions, and when a company tries to get into a business line, it doesn't matter if it's buying a company that produces this. It doesn't matter if they're trying to get it into it organically, so they're just starting from scratch. Um, they're trying a partnership or an allied partnership or something like that. It doesn't matter how they're getting into it. However that's done, the question is of value. Okay. Is it worthwhile to get in there? So that gets us back to our rules. Why would you do this? What are the theoretical reasons it would be wise to go after uh, this other type of company? And here's your answer. Notice on the bottom, it's the same as the textbook. It's synergy, it's synergistic benefits is what has to materialize there. Um, and that's the idea that 1 + 1 = more than the sum of its parts. So 1 + 1 = way more than two. If I'm outside doing a project and I'm doing it by myself, maybe I'm trying to move something or build something, I there's a lot of things I can't do. If I have my son helping me, and my son actually for the last 2 weeks has been working with one of my wife's colleagues, helping to build or expand their house or do something, do building of some sort. But my son doesn't know jack crap about building anything, and every time I've tried to teach him how to run a saw, even it's like, oh, Dad, I get it, I know. Um, but he goes over to this guy's house, and I'm like, what's my son gonna do? He doesn't hardly understand how to use a drill driver. But the reality is because this guy needs somebody to just hold up the wall as they're trying to, nail in the framing of all this stuff. And with two people, he can do more than just by himself, which doesn't work. So with this gentleman and my son working together, they can do far more than either one of them could do individually in trying to build this house. That's synergy. Okay. A real quick story for you. Um, Number of years ago, there was, I don't know how much of this I should have online. There was a company that was being bought out by a publicly traded company. And as this was going through, I had heard that the company that had been targeted was actually adding jobs. And they were adding jobs in their administrative departments. And I heard that, and I was talking to a buddy of mine, and he said, because his wife had worked there at the time, and he was scratching his head. He's like, why on earth are they adding administrative headcount? That does not make any sense. And the argument was because it wasn't high enough when it was privately owned. And again, that didn't make any sense. Why? Because you have to have that synergistic benefit. The way that's achieved is when the parent company goes and buys the target company, they don't need three payroll specialists. So one of the payroll specialists gets kind of bumped off, or HR people get sent off. And then you have the parent firm's HR people who probably weren't working at capacity anyway. And now they're just doing more work. So you're able to do more with less people. So the whole point of that, or a piece to this synergistic benefit is not how do I say this? Usually a big piece of it is the administration of it. It's getting out headcount that's not needed because we weren't running at capacity in the first place in the administrative function, not like production. Okay. Then we had some bad reasons for companies expanding. Diversification in product of product lines or portfolios. Diversified being getting into something unrelated. Why aren't we supposed to be doing that? Because we go back here. It has to create shareholder value. There is no option in it. It has to do that. Otherwise, they fire the management, whoever's bright idea it was to do this. Okay. So those are essentials. You don't have a choice behind that. And I do like how the textbook brings that up. Like if the shareholders are not satisfied of your rationale and logic, then they just fire you and get rid of you until they can find somebody that does have that logic. You can't diversify just because, well, let's go do something else we don't know how to do. The investor's job is to diversify. The principal's job is to diversify, not the agents. Okay. Now, all that being said, we're going to talk about what your book calls diversifying into different business lineups. So, here are some options for entering into new industries and new lines of business. You could diversify by acquiring another business, which we've been talking about. Another one would be to grow organically and do this and start it yourself. And the third way would be to create a joint venture to get into that diversification. There's that fundamental idea is anything in strategy. You can go buy somebody that knows how to do it. You can try doing it yourself, which usually isn't the best option. Sometimes it is because maybe nobody else is doing it. But a lot of the times it's not a real great option because the hardest thing to do in those ventures is to generate revenue. It's that first 5 years, if you can get past that. So if you have a company that's 15 years old, they figured out how to do this. They figured out how to be sustainable. They figured out all the lessons that had to be learned to do this, and they're still standing. So that's why you pay a lot more for those companies than just the assets that that organization possesses. Okay. And then the last one was the joint ventures. So those are your three options when trying to diversify into a business. Um, I'm trying to understand what we're going to stop here for a second because I don't slide doesn't look right. So I was reading this one a little bit wrong and misunderstanding it when I was reading it. So if you have a company like 3M who is in, it's a conglomerate, it's in many different types of businesses. The question is, well, what options do you have to further diversify or not? Or like, what should we do? And are we bored or what's going on? And your option is one, you can stick with the existing business lineup uh, and try to generate organic sales. So that was option number one in Ansoff, which is market penetration. The next one would be to broaden the scope of diversification by entering into additional industries. Okay, another option there might be you're going into a new type of product line. So that would be your product development. Another option would be to retrench to a narrow scope of diversification by divesting poorly performing businesses. Okay, so that goes back to our Boston Consulting Group ideas. You ditch your dogs. Okay, you don't want to keep those. Um, but many times companies do keep them because they are a complement to some other product they have. And if you get rid of that, your customers will be disappointed. But when you diverse or divest, I don't like that they put diversify and divest in the same sentence. When you die, because you're not diversifying anything when you're divesting, you're doing the opposite. You're narrowing your scope. Um, and you may do that when that business line is not performing well. And it's not uncommon for like a large company like 3M to divest a product line that is not doing very well. And they might try to sell it to a group of engineers or people that work in that department. And maybe they'll, say, well, here, we'll spin you off and you guys can go find your own warehouse to operate and manufacture this, and we'll sell you all the everything associated with this, but you just need to find your own house to do this in. Um, where they do that, and then all of a sudden that business will take off because you have a much more laser-like focus by the people that the five or six people that now own that business versus when it was one in 1,000 of different business lines that nobody was really watching very well. Okay, that's not uncommon. And then lastly, broadly restructure the business lineup with multiple divestitures or acquisitions. I don't know where they're going with this, but yes, those are all your options. We see that with the Ansoff matrix. Um, oh, let me go back to this one because I actually like this bottom chunk here. Um, when in a corporate setting, when this is happening, this type of planning is very demanding. Um, Sorry, from time to time, I have a son or daughter that needs me for something important. So that was one of these. Okay. So what I was reading here is in a corporate environment, the demanding and time-consuming nature of these four tasks explain why corporate executives generally refrain from becoming immersed in the details of crafting and executing business level strategies. Why? Because if you look at the head of General Electric, okay, a long time ago, it was a guy by the name of Jack Welch. And Jack Welch was a petroleum engineer. That's what he knew. He knew how to, chemicals and how to make plastics and how to extract everything under the sun with petroleum type products. He didn't know very much about building jet airplanes. And actually, General Electric got into corporate financing in different, actually, I think a credit card company and some other different ventures. Jack Welch doesn't know anything about the banking world or credit world. Jack Welch knows nothing about jet engines other than, well, we can use this type of fuel in there. He knows a little bit about engineering, but he's not familiar with that. He doesn't know the industry. No person at the top of a 50 or 80 billion dollar company is going to understand the intricate nature of any given different business line in a conglomerate. They're just not. So what we're saying here is it's very common that if those types of strategies are being looked at, you actually have a people leaders, executives that are a couple levels down that are the business level managers. Okay. Business level meaning like at 3M, you have a healthcare sector. You have an industrial products division. You don't want the CEO of 3M to be taking part in the strategies of growing those businesses because the CEO of 3M is not going to know how to do that. Okay. You have somebody at a lower level that does understand those industries and then how to strategize and implement a strategy to grow those business lines and to figure out where is this going. So again, I like how the book said a lot of times you're not going to see the corporate executives. If you're a corporate executive, what you need to remember is the same idea as the principals or the investor class, that the logic has to be there. And if you don't understand business and you don't understand strategy, then it's very easy to get the wool pulled over your eyes about some sort of strategy and think, oh, yeah, that sounds good. Oh, yeah, why not? Let's try that. When we talk about value disciplines, it's not uncommon for a very intelligent manager who's well meaning says, well, I think we need to do as much about customer service as cost. And it's like, no, those are different things. You're not gunning, you can't gun for both of those and expect it's necessarily going to end well. I mean, one in a thousand, yeah, maybe it will, but probably not likely. Okay, so again, the folks that are actually doing these types of strategies in conglomerates are usually specialists in certain industries or certain fields. Um, yeah, leave it at that. Uh, So then they talk about developing an overall corporate strategy. What does that mean? Okay. Um, when you're doing that, you're trying to find a overarching corporate sustainable competitive advantage. You're trying to figure out what is it the thing that we're trying to do, or what is this company? What are we known for? What do we do best? General Electric was looked at with laser-like focus for like 20 years when Jack Welch was leading it, because they went from like $1 billion company and turned it into like an 80 or $100 billion company. He grew it by so many times over and over again. Then the way he grew it, he shared it with everybody and told everybody, here's how we did it. We used Six Sigma. We used this performance evaluation system that got rid of the dead weight in the company, and we fired the bottom 10% of employees that weren't performing. Okay, so what that turned into was, or what they claimed, was we knew management. We knew how to run businesses and we knew how to run companies. So they turned buying other companies into a sustainable competitive advantage. They created General Electric to be specialists in those acquirements of these other companies. Okay. All right. So when you're crafting a diversified firm's overall corporate strategy, like a General Electric, okay, um, some of the options you have is looking at a new industry to enter into and figure out how you're going to get into that. Another option would be to pursue opportunities to leverage cross business value chain relationships into a competitive advantage. Okay. It's paying attention that, hey, wait a minute, we're in these two different product lines. And both of those product lines share something. Maybe they share the customer, a partial set of customers. Well, maybe if we got into that business line and we did this and we did that, we would start a whole new type of business or a sharing of the business that would cut costs by 80%, something like that. Okay. Establish investment priorities and steering corporate resources into the most attractive business units. So you're looking which industry has, or which business has the best growth prospects. Boston Consulting Group type stuff. And then number four, initiate actions to boost the combined performance of the corporation's collection of business. What does that mean? It means you're trying to piece everything together to make it flow as effective and as efficient as humanly possible. When you do that, and you have hopefully would develop a culture that can do that, that's when you maximize your position. I don't like this here, this undernote. I saw that earlier. The decision to dare to diversify presents a wide range of possibilities. A company can diversify into closely related businesses or into totally unrelated businesses. No, they don't. It can diversify its present revenue and earnings based to a small or major extent. It can move into one or two large new businesses or a greater number of small ones. It can achieve a diversification by acquiring an existing company, starting up a new business from scratch, or forming a joint venture. We've got all these options. Yes, you do. But no matter, you have to create shareholder value. Otherwise, you get fired. Okay, and you bring in somebody else that knows how to do this. So you can get to say unrelated really gets under my skin. Um, Here they're just talking a little bit about diversifying by acquiring a new business. You might do so. This goes into the same as the mergers and acquisitions in the master strategy tools. You're trying to learn technological know-how that might pair nicely with what you currently know. Maybe you're trying to develop a deeper supplier relationship somewhere in the val or the supply chain. You're trying to achieve a better scale of economies of scale or scope. Try to enhance brand awareness, secure adequate distribution access. I'm not going to get into that. The big dilemma is whether to pay a premium price to buy a successful firm or to buy a struggling firm at a bargain price. Well, yeah, or not. So I do want to stop there. I think we're going to break this out into a couple of different videos. So I ran through really quick this idea of stock valuations. Um, I'm going to show you how to do this again so you understand what we're doing, the process, why we're doing it, and why it matters. Okay. So what they're saying here is if a company is its price and earnings makes it look level to its risk, makes it look like it's an undervalued company. Okay. Uh, then it's underpriced. So you're getting a cheap deal on a business. Okay. The question is, well, how do you determine that price? And the answer is you hire your finance people to do a stock valuation or evaluation of the company and try to figure that out. And that's something I teach students to do in management, personal finance, just to learn portfolio management. Um, I think I did it in a marketing class a while back, but I used to also teach it in a finance, MBA finance class. So let me hit a quick pause to make sure I have all my screens up, and then I will share this with you. All right, I got everything up. So the question is, the textbook is asking when should you buy a company if it's a partially diversified company? Okay. And the answer to that is, or the question is, do you buy it when it's undervalued or do you buy it when it's overvalued? Because if you buy it's overvalued, then you're paying a premium over what maybe you could have done this by yourself on your own, which again is not a good idea, but it might be a better idea than paying way too much money for diversification that there's no value in it. Okay. So that gets us into I'll bring it down. Gets us into stock valuation. So companies that are targets for acquisition are usually undervalued. Okay. And that the reason is because that's a good theoretical justification is you're getting a good deal for this. Why not do it? So what do we mean when we're talking an undervalued company? So we do a stock valuation. This is all interrelated to strategy. So if we look at a company, we're going to do Ford Motor Company. So if you wanted to buy Ford, we'll say we're Tesla. If we're Tesla and we want to go buy Ford Motor Company, the question is, well, I don't know, is $10.43 per share a good price? Would $41 billion be a good price or are we paying too much? So you do a quick stock valuation. How do we do that? First thing we do is we run a capital asset pricing model, which is a very simple forecast or formula. So the first thing we have to know is what's the return available on a benchmark or a company that's a similar size as Ford. And the answer is from Ibbotson and Associates, Ford is a large cap stock and the rate of return, historical rate of return is 10.4%. So we're going to enter into our calculation 10.4. Next, what is the absolute risk-free investment that a person could ever get their hands on? For the most part, we use the 10-year Treasury note. The rate of return on the 10-year Treasury note is 4.39%. So we go back in here and we enter in 4.39%. Next thing we know is, well, how risky is Ford? And the answer is the beta coefficient, which is how we interpret risk, is 1.51. So it is higher risk than other companies that trade on the New York Stock Exchange. So below one is lower the risk than the market. One exactly is the same. More than one is more risky. So we're going to put in 1.51 for our risk. We hit calculate. What that means is based on a level of risk, we need to receive a rate of return of 13.47%. Otherwise, this isn't worthwhile. The problem is the earnings are what stays the same. It's the stock price that goes up and down. So we kind of got to do the math backwards, kind of, to figure out if this is worthwhile. So the next question is, what are the earnings per share for the trailing 12 months? So we go back here, we see on our Yahoo Finance, the earnings per share for the trailing 12 months, EPS DTM is $1.25. So I go back here and I enter $1.25. Next, we have to figure out how much are these expected to grow for the next 5 years. Um, Most of the time, a company has to grow by more than 3% because that's inflation. If it's not, the stockholders fire the executives and bring in new people that can do it. So right here, there's 100, well, there's 25 different ways you can analyze this number. We're going to use this one here, which is revenue growth for the next 5 years annually, or 5.69%. I got that from Seeking Alpha because Yahoo Finance stopped publishing that number. So we're going to go back in here and we type in 5.69%. Those are expected to grow for the next 5 years until leveling off to inflation, which is 3%. So then we have our risk adjusted discount rate that comes from here. So our stock price per share should be worth, Ford should be worth $13.70. What can we buy it for? $10. So you have an investment you think is worth $13, but you can buy it for 10. That means it's undervalued. It's cheap. It's like finding a $50 pair of jeans for 10 bucks. Okay. That's what it is. So this is a good deal. This is cheap. This is undervalued. So in your textbook or in our book, when they talk about, do you acquire when it's undervalued or do you acquire and pay the premium if it's overvalued? Now, we could do the same thing with another company, let's say Tesla, and we could find out, we would find out Tesla is overvalued. But might it be worth the premium? And that's dependent on, well, how much is it expected to grow in the next 5 to 10 years? Okay. So that's what we're talking about. To figure that out, you just do a valuation, and you can do that for private businesses as well. Now, again, some of the reasons you want to do that to acquire the technological know-how that maybe you don't, that would blend nicely with your current core competencies. Try to establish supplier relationships, achieve scale of economies of scale, build brand awareness, secure adequate distribution access. And then the question is, do we buy this at a premium or do we try to get a good deal? Okay. Another option might be maybe the company is adequately valued or even overvalued, but maybe the seller or the owners of the company want to get rid of the stupid thing. So maybe they'll give you a good deal. Typically, when you're entering into a new line of business through internal development, so that's not acquiring another, uh, let me rephrase that. You know what? We're not going to do that either. I have to get going here. I got another event tonight. So we're going to stop here on chapter 8. We will start at, we left off at slide 9, and then we'll get into the rest of this because we got through a lot. And otherwise, that's too much. So we will see on the next go around, chapter 8, starting with slide 10. Have a good day. We'll see you on the next go around.